Most Forex brokers have available certain lot sizes, such as the standard lot size, the mini lot size, and some brokers have a super mini or micro mini lot size. Sometimes when traders are just getting started, they will ask this type of question to other traders, such as, how much money will I make in a trade? How much is a pip worth? Well, once you understand how a Forex trading account works, you will know that you should never ask another trader how much a pip is worth. Ask that to your broker, because it depends on what kind of account that you choose. What is a lot? A lot traditionally refers to $1 million in the Forex market. Today, it seems that what we call a standard lot size is a $100,000 lot size. A mini account has a $10,000 lot size. A super mini account has a $1,000 lot size. Now, don't be too afraid of these numbers if you're not starting with a lot of capital, because you're going to see that you can actually trade a large amount of money in the Forex market with a small amount of capital. Let's take a look and see how that works. If you have a standard lot size of $100,000, that's a type of account that you would open with a Forex broker, and your account is set to, say, 100-to-1 leverage, which is typical for a lot of brokers. That means that you will deposit $1,000 for each lot that you trade. What do we mean by deposit $1,000? Well, let's say you could have an account with $20,000 in it, and if you enter a trade with one lot, $1,000 of that capital would be held while you're in that trade. As soon as you enter the trade with one lot, $1,000 is placed on deposit in that trade. Let's say if you have $30,000 in your account and you choose to risk 3% of your account per trade, that means that you would be willing to risk $900. That amount happens to be less than the deposit for one lot, which is $1,000. Therefore, you would need to either deposit more funds into your account or go with a different type of account. For instance, if you contacted your broker and opened an account with a $10,000 lot size instead of $100,000 lot size, with the same 100-to-1 leverage, each lot would cost $100 for deposit instead of $1,000. Therefore, with your $30,000 capital in your account and your decision to risk 3% per trade, you could now trade 9 lots instead of having one lot exceed your risk level. Some brokers now offer accounts in which the lot size is $1,000 and the leverage can be as high as 200-to-1 or even 400-to-1. That means that you could start with a small account, such as a $500 account, and trade 2 lots at $2.50 each for deposit, and only have 1% of your $500 account at risk. Many traders who have had some experience in stocks or commodities do not quite get this. And often you might hear a lot of people saying that Forex trading is very risky or something like that, when in fact you can risk much less capital in Forex than in other markets. If you want to see what's risky, see what some commodities brokers are doing. Have you ever talked to someone who has traded commodities and met someone who got interested in trading commodities and went down to a commodity broker? And for instance, I met this one gentleman, he said, yeah, I took $20,000 down to the commodity broker, and wanted to buy copper, so he bought copper. And the next day, the broker called him up and said, well, the market has moved slightly against you. In order to maintain your position, you need to bring in more money. Because you see what they're doing, putting the entire amount of capital into a trade, and you can't even stay in the trade, even if it moves slightly against you. Well, I consider this to be very unscrupulous on the part of the commodity broker, who is taking the money from the customer and not explaining proper risk management. But that goes along with the idea that placing a trade is sort of like a gamble, like maybe you'll hit the jackpot today. But that's not likely, because markets fluctuate even as they're moving in one direction. So you have to have some breathing room for your trade, and you should never risk all of your capital on a trade. So instead of opening an account like we do in Forex and managing the amount of risk at a level of, say, 2% or no more than 5%, they would bring in $20,000 and put it all into one trade. So the next day they were required to bring in more money. And obviously the brokers are not trying to help develop successful traders when they're doing this. They're just taking the money. Well, you must understand what lot size refers to in your account and how much is required as the deposit to enter each trade for one lot. And then you must understand what is the value of a pip in your account for each lot that is traded. These are the most basic, most important things that you should understand about how Forex trading accounts work, and the best way to understand this is to call your broker, open a demo account, have them explain to you how this works. Open a trade with one lot in your account and observe what happens in a demo account. Try opening different types of accounts for a demo account. Open a standard lot size demo account. Open a mini lot size demo account. Open a micro lot size demo account. And open a trade in each of these accounts and observe what happens and be aware of what the numbers are doing in your account. How much money do you win or lose with a certain number of pips profit or loss? So how much is a pip worth in your account? In a $1,000 lot size account, what we call a micro, mini, or super mini lot size account, the value per pip is 10 cents, regardless of the leverage. And this is approximate because it's only even for most of the major currency pairs. Some currency pairs, it's not exactly that amount. But it makes things simple and easy to use that rounded off exact even amount, 10 cents, $1, $10, and most of your currency pairs will be that, but some of them will not. Just be aware. If you have 400 to 1 leverage, you would deposit $2.50 for each lot. At 200 to 1, you would deposit $5. Still a very small amount. So, we've been talking about the risk in your trade and sometimes referring to the amount of risk as the amount of your deposit per lot, but that's not exactly correct. It's important to understand that your risk is based on the number of pips that you're willing to go negative, or the number of pips in your stop loss, not the amount of your deposit. Let's take a look and see how that works. For instance, if you have a $10,000 lot size, that's a mini account, at 100 to 1 leverage, each pip is worth $1 per each lot traded. So just get that in your mind. Mini account, $1 per pip. That means that if you have $5,000 in your account and you choose to risk 5% of that account, you would be able to trade with $250 at risk. And since each lot requires a $100 deposit, you could only trade 2 lots without exceeding your risk tolerance. If you traded 2 lots, that'd be $200. 3 lots would be $300. That would exceed your risk tolerance, right? Wrong, or not necessarily right. If you use a 50 pip stop loss for the trade that you're entering, you are risking $50 per lot traded, not $100. That is, you could not lose more than $50 in that trade because your stop loss is set for 50 pips away from the price where you enter. Therefore, with a 50 pip stop loss in this particular account, you could trade 5 lots instead of 2. 5 times 50 is 250. And with 5 lots traded and a 50 pip stop loss, $250 is the maximum you could lose. You could not lose more than 250. And remember that based on the amount of deposit per trade, we were just thinking that even 3 lots would be risking $300. So now you can see that that's not correct. If you have a 100 pip stop loss, you would be risking $100 per lot in this type of account with this number of pips in your stop loss. And in that case, you could only trade 2 lots. Later you will learn where to put your stop loss and why when you enter a trade. But let's just say, for instance, that you entered a trade here and you're selling at a price of 161.39, and you place your stop loss above the most recent high at 162.25. That gives you an 86 pip difference between the price that you enter the trade and the price of your stop loss. And that represents how much risk you have in the trade, because if you do lose this trade, that's exactly how many pips you will lose. So if you multiply the number of pips in your stop loss by the number of lots you're trading, and multiply that by the value of a pip in your account, keeping in mind that the value of a pip in your account may be different from the value of a pip in someone else's account, depending on what type of account you chose to open, and you're clear about the value of a pip through your broker. When you opened your account, you decided what type of account to open and how much the value of a pip would be in that type of account. That would tell you the actual dollar amount of risk that you have in a trade when you enter a trade. So the process of determining your risk is actually done backwards. First, you decide what percentage of capital you will have at risk in a trade throughout your trading business. 2% capital at risk is a recommended industry standard for maximum risk in a trade. What that number is based on your win-to-loss ratio and your risk-to-reward ratio. For instance, if you risk 5% of your account, that represents the dollar amount that if you lost 20 times in a row, your account would be completely depleted. So as you can see in trading, there are wins and losses. It's part of the business. It's a business of probabilities, and therefore you need to manage your risk in a way that your account will never be depleted. So do you follow this? How to calculate your risk when you enter a trade? If not, just review this again and try some samples in your demo account for practice. Open a trade, place your stop loss, and see how many pips are in the stop loss between the price you enter the trade and the price of your stop loss. And then let the trade run, and if you win, fine. And if you lose, see how much did you lose? How many dollars did you lose? How many dollars are in your account? What percentage of capital does that represent? There's really nothing but basic addition, subtraction, multiplication, and division involved here. But you must understand, what is the lot size in your account? What is the leverage that's available to you in your account through your broker? What is the amount of deposit per lot? What is the value of a pip in your account? And what is your risk based on the number of pips you are exposing yourself to with your stop loss? Can you see also that the way to really learn this is to open some demo accounts and talk to broker representatives and understand how a Forex trading account works that way? That's the best way to learn how this works. All right, I have explained how this works and showed some examples. The rest is up to you. I want to caution you, do not trade with a live account unless you understand these numbers. Before ever entering a trade, make sure you understand how much capital in your account is at risk in case of loss in that trade. I have had people tell me they were trading and doing well, and then the market turned against them and their account was completely wiped out, or they had a margin call. And I have to say to them, I don't know what you were doing, but it shouldn't be possible for that to happen. Obviously, I just explained that even if you had as much as 5% of your account at risk in a trade, which is way more than the industry standard recommended amount of capital at risk, you would have to lose 20 times in a row in order to have your account depleted. So did you lose 20 times in a row? And then if you did lose 20 times in a row, obviously you didn't learn how to trade before you started using real money. You would think that this is common sense, but here's some advice I'll give you. First, learn how to trade. Then, you would think that this is common sense, but here's some advice I'll give you. First, learn how to trade. Then, use a live account. If you lose a live account, it's because you didn't learn how to trade before you started risking real money. Whose job is it and whose responsibility is it to understand the numbers in your account? It's yours. It's your business. That's the first thing you want to know. How does your account work? If you would like to see how much money you will make with a certain number of pips profit, the best way to do that is to open a demo account, place some trades, and observe the results while using these calculations. You should be thoroughly familiar with how this works before you ever start using real money. So let's make some important calculations that are used in Forex trading. If you take the lot size of your account and divide it by the leverage that you have in your account, that would tell you the deposit per lot. For instance, if you have a standard lot size of $100,000 with a standard leverage that's available from most brokers of 100 to 1, take the $100,000 lot size and divide it by 100, and $1,000 is the amount that you deposit per lot to enter a trade. If you have a mini lot size of $10,000 with the same 100 to 1 leverage, then your deposit per lot traded is $100 instead of $1,000. Lot size divided by 10,000 equal the value per pip. Let me explain that. If you have a mini lot size of $10,000 and you divide it by 10,000, the result is 1. So in a mini lot size account, the value of a pip is $1 per pip. Now keep in mind that that's the value for your major currency pairs, but not all currency pairs are exactly the same. But to keep things simple and easy, we'll just use that. Your main currency pairs will be $1 per pip. In a standard lot size account, the value of a pip is $10. So just keep in mind, if you have a standard lot account and you enter a trade and you earn 100 pips, multiply that by $10 and see that oh, you just earned $1,000 if you're trading one lot. And eventually you might be trading 10 lots per trade. You might be trading 100 lots per trade, and you might earn 100 pips in a trade. The more you see how the numbers work in Forex trading, the more excited you will be. Lot size times 0.001 equals the value of a pip. Number of lots times the pip value times the number of pips in your stop loss equals your risk in a trade. For instance, in a mini account, if you're trading 2 lots times the pip value, which is $1, that would be 2, times the number of pips in your stop loss. Let's say if your stop loss was 50 pips, it would be 2 times $1 equal 2 times 50 pips equal $100 is your risk in that particular trade with that particular type of account. If you take the balance of your account times the percentage of risk that you choose divided by the number of pips in your stop loss times dollar per pip, or the value per pip, that equals the maximum number of lots that you would trade. For instance, if your account has $5,000 in it and you choose to risk 2% of your account times 0.02, that would be 100, divided by the number of pips in your stop loss. Let's say your stop loss was 50, divided by 50 equals 2, times the dollar per pip, or the value per pip, which in this case was $1 in a mini account, equals 2. That's 2 lots that you can trade in a $5,000 account with a 50 pip stop loss. It's not quite as complicated as it might sound, and to make things easier, go to our website. Somewhere under Tools or Resources, you'll find some type of a risk calculator there that you can actually put in the amount of capital that you have in your account. You can tell the calculator how much is the value of a pip in your account, and what's the lot size in your account, what's the number of pips in your stop loss, and what is your chosen percentage of risk, and then it will tell you how many lots you can trade. If you really intend to be successful in the Forex trading business, you will make sure that you thoroughly understand this before you start trading with real money. Let's look at some trading plan examples using a trading income calculator. Log into your membership site that comes free with this course and locate the video on the risk calculator. There you can see a demonstration on how to use the risk calculator. After you have viewed the video on the risk calculator, take a look also at the video there on the Forex trading income calculator. This shows you how to project possible income based on the amount of capital that you intend to start with, type of account that you intend to use, and the number of pips that you intend to gain on average in your trading business. Alright, let's talk about Forex brokers. If you are just entering the world of Forex trading, it is important to understand the nature of the industry. The industry is driven by brokers, and their agenda may be different from yours. As we will discuss later in the Forex Secrets workshop, almost all training programs are also connected with the broker industry as introducing brokers. Some training programs are offered directly through a broker, and the methods they teach may be aligned with the agendas of the brokers, which may be different from yours. See, the broker's agenda is to make money from your trading. The best way for you to make the most money might not be the technique that the brokers want you to know. It is well known that the majority of people who enter the Forex trading industry will lose their entire accounts. And the business models of most Forex brokers is designed to capitalize on that well-known fact. And there's nothing really wrong with that. There's nothing unscrupulous or unethical about the fact that Forex brokers are providing a service and they know that most people will lose their accounts. That's just a principle that's known in all business. And it's very interesting that I learned the same thing is true in all small businesses. Once I heard from the Small Business Administration in America that 95% of all small businesses will fail within the first 5 years, and then I learned that it's also a principle known in all business. In the real estate business, I was taught that 95% of all the real estate business is accomplished by about 5% of the agents. So it's really nothing shocking to learn that most people will lose in Forex trading. That's just a normal principle in all business. And if Forex brokers have a business model that is designed to capitalize on that fact, well, that's just regular business practice. It makes sense. For now, let's just consider looking at several brokers and opening demo accounts in order to get accustomed to trading. In order to get access to the Forex market, you need to open an account through a Forex broker. Therefore, Forex brokers are our business partners. Our businesses are dependent on maintaining a professional relationship with a good Forex broker. At this time, I have no introducing broker relationship with any broker. I am not an introducing broker for any broker, and so far I never have been. And I'm not really recommending any particular broker at this time. Therefore, I am recommending that you spend some time researching the broker industry. Here are some things you might want to look for in a broker. If you have a small amount of capital to start with, you'll want to know what is their minimum account size. If you have a lot of capital to start with, or maybe later on in your Forex trading business, this might not be a concern for you. You might not choose a broker based on what their minimum account size is if you have a lot of capital. But if you do have a small amount of capital, this will be a very important consideration for you, because some brokers will allow a minimum account size of $300 or $500, whereas some brokers have a minimum account size of $10,000 or maybe even $100,000. What is the maximum leverage available, and is it limited according to certain account sizes? Well, it's nice to have high leverage available, but what I have found is that most of the more legitimate brokers have a maximum leverage of 100 to 1. There are some brokers that have 200 to 1, 400 to 1 leverage and very small minimum account sizes, and if you're just getting started, that might be attractive to you. Later on, your needs may change in a broker. What is the broker's policy on interest rates for carryover trades? Are the interest rates displayed in the trading platform? Well, when you hold a trade for more than one day, when you hold a trade past the end of that broker's trading day, there is an interest rate differential that is either charged or credited to your account. It can be a positive credit if you're buying or selling the right currency pair that has a positive interest. This might be a concern to you if you're going to do a lot of trading in which you hold trades for more than one day. Later in the course, you will learn how to trade on all time frames, but you will learn that many times it is desirable to hold a trade for more than one day. And if you do hold a trade for more than one day, there will be an interest rate that is either charged or credited to your account. So it's very important to know what is the broker's policy on interest rates and take a look at their actual interest rates. Are the negative and positive interest rates comparable, or are the negative interest rates consistently about twice as much or more than the positive interest rates? I found that a lot of brokers have interest rates that are about twice as high on the negative side as on the positive side. And I'm not quite sure why this is, but not all brokers have interest rates that are twice as high on the negative side as on the positive side, and therefore that tells me that if they do have interest rates that are twice as high on the negative side, that it kind of indicates to me that that broker might have a little bit of an unethical business model. And if they do have an unethical business model, it might show up in other areas. Why would they have interest rates that are twice as high on the negative side as on the positive side? Well, you see, apparently brokers can just make up whatever interest rates they want. And if they're twice as high on the negative side, the end result is that over the long term, all interest will be to their favor. Sometimes they'll pay out interest, sometimes they'll charge interest, but over the long term it will be all in their favor. Well, the interest rate is supposed to be the difference in the interest between two currencies of two different nations. Like the US dollar has a certain current interest rate, and the Australian dollar has a certain current interest rate. And when you buy or sell that pair, there will be a positive or negative difference between those two interest rates. So that tells me that if it's twice as high on the negative side, the math just doesn't work somehow to me. It would seem that the interest would be about the same on the positive and negative side. So that's just one of those things that you might check out. You just might want to see, what is that broker's policy on interest rates? Another thing you will want to consider, what currency pairs are available? If a broker doesn't have all of the currency pairs that you would like to trade, then it could affect some really good trading opportunities that come up now and then. You might want to trade the pound versus the Australian, and then you discover that that particular broker is missing that pair. Well, some brokers now have 60 or 100 or more different currency pairs, and for the most part you'll probably never trade all of those pairs. But you do want to have the important 20 or 25 currency pairs that most brokers have. What trading platform software is used with this broker, and what is it like? Is it really advanced and highly technical, have a nice user interface, or is it kind of clunky or cheesy looking when you try to trade on it? Keep in mind that trading platform software is not necessarily the same thing as charting software. Nowadays, MetaTrader is very popular, and a lot of brokers have MetaTrader, and the main reason that most traders like MetaTrader is because it includes really nice advanced charting software. But a trading platform is a software that you use to enter a trade. Charting software might be a different thing. Charts should not necessarily be the determining factor about why you choose a certain broker. Again, a lot of traders now prefer MetaTrader charting software, and there are a lot of brokers that offer it, but you may not want to choose your broker based on that. And in fact, you might choose a broker based on some other reason, and you might subscribe to some other professional charts instead of using MetaTrader, and that's just fine. If the broker that you select does not have MetaTrader, or does not have charts, or has some kind of other proprietary charts, that shouldn't necessarily be the reason that you don't choose a certain broker. Do not be lured by free professional charts, like if a broker offers you a free subscription to eSignal or some other bonus like that. The requirements to qualify for these free gifts and free bonuses usually means that you'll have to trade a certain number of round lots per month, and you end up more than paying for whatever it is they're giving you. Just keep in mind that any kind of a free bonus or something is not the reason that you'd want to choose a broker. Choose the best broker and get the best charts. And if you decide to go with a broker that has MetaTrader, that's fine. If not, that's not the main reason that you would want to choose the broker. Don't be lured by apparent low pip spread or pip rebates. Choosing a broker based on pip spread, I think, is the most ridiculously stupid reason to choose a broker. The best brokers all have approximately the same competitive pip spread. But if there's some broker that pops up that has a little bit less, a little bit lower pip spread, that would be the last reason I would ever consider choosing that broker. Brokers with the lowest pip spread are often the ones that are the most notorious for price manipulation, so that you would end up paying way more than you would with just a regular pip spread with a more reputable broker. Pip rebates are simply an introducing broker attempting to bribe you by sharing their profit because they can't offer any other legitimate reason for you to choose to trade with them. And what is the belief that's behind not wanting a broker to make money from doing business with you? It's really an anti-capitalist, anti-prosperity belief. You should want your broker to make money from doing business with you, and you should choose the best, most professional, most ethical broker that you can find and choose based on those things. And whatever pip spread they have is fine. In fact, if you're focusing on the cost of the pip spread, how can you possibly be focusing on the tremendous profit that's available to you? The profit that's available to you is so much greater than the pip spread that people who are consistently focusing on the cost of the pip spread are very likely to be the people who have belief systems that will prevent them from being successful and experiencing abundance. Another thing to consider is, what is the company's financial strength? At this point in time, there have been a number of brokers that have gone out of business, filed bankruptcy, undergone audits that have shut down access to their customers' accounts. And if you have ever experienced this, if you have ever known anyone who has experienced this, you should know by now that the most important thing when choosing a broker is that the broker is going to be in business for years to come. Why is it that so many traders gravitate towards new companies that just popped up that no one has ever heard of? I have people ask me all the time, what do you think about this such and such broker? And I've never heard of them. If I've never heard of them, then that's a pretty good indication that I don't want to put my capital there with that company, especially after seeing so many brokers go out of business. There have been a lot of traders who have lost their entire accounts to brokers that have gone out of business. It should be clear by now that the most important thing when choosing a broker is that the broker will continue to be in business for years to come. Does the broker offer hedging, entry orders, trailing stops, etc.? At this point in time, hedging has recently been disallowed in the United States, but you want to know what kind of features are available in terms of what types of automated trade execution methods can you perform on your trading platform. An entry order is where you set a certain price where you want to automatically enter a trade if the trade reaches a certain price, and have it automatically include a stop loss, and you may want to have automatic limit orders and so on and so forth. It's just a good idea to check with the broker and see what kind of features do they have for trade execution. You may not want to do business with a broker that does not permit opening hedge trades, which is a technique covered in advanced workshops. Later on, you will learn how you can have trades on different time frames in different directions that are both profitable trades. Hedging is only productive if it's used for the purpose of entering trades in opposite directions on different time frames. For instance, you might have a trade in which you're buying the euro yen and holding it for the next 3 weeks, while during the deductive, if it's used for the purpose of entering trades in opposite directions on different time frames. For instance, you might have a trade in which you're buying the euro yen and holding it for the next 3 weeks, while during the day tomorrow you might enter a trade short in the opposite direction, but only hold that trade for a few hours and close it with profit while your other trade continues to run. And that's a very legitimate strategy for trading. So I found that it is undesirable to have a broker that does not allow hedging. Hedging is simply having 2 trades open on the same currency pair in opposite directions at the same time. What country is the broker located in? Where will your funds be held? In some countries, your funds are actually held with a third-party bank. Some countries have segregated accounts available. That is, your account is held separate from all other customers with that broker, whereas with a lot of brokers, all the funds are pooled in one account. What seems to be the consensus about the broker's reputation with other traders? Here's a caveat: there are many immature traders, and since you already know that most traders will lose, you don't necessarily want the opinion of most traders. A lot of immature traders will rave about their broker like it's their football team. Yay, rah, 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 my broker is so great because I trade with him, and that's the only reason. And then at the same time, they will criticize brokers that are some of the best brokers. And some of the very things that they criticize are the very things that demonstrate that the broker is legitimate. So I will just tell you right now that if you begin searching on the internet for information on brokers, 95% of brokers will lose, 95% of traders will lose, 95% of traders have no success consciousness, have no success training, and their opinions should mean very little to you. At the same time, you do want to know, what do the most successful traders say about certain brokers? You want to have some kind of consensus available to you about what other traders are saying. When you're looking for a broker, you may have to choose which things are the most important to you. You might not be able to find a broker that has everything you want, so you can choose what are the most important things and then go with that broker. It's more important that you open an account and start trading than it is to continually search for the ideal broker, because there may never be an end to that search. At the moment, I don't necessarily have a broker that has all the features and benefits that I desire. Therefore, I just choose the lesser of evils in order to get the features that I most desire. And I trade with multiple brokers to minimize risk and have access to different features. Don't put all of your eggs in one basket is a saying that is very true in the Forex trading business. If you have accounts with more than one broker and something should happen to one of the brokers, at least you still have your other account that's not affected. The rest is up to you. If you want a Forex trading mentor to recommend a broker to you, be advised that almost every Forex mentor in the industry will be happy to recommend a broker due to her or his introducing broker affiliation. And this is the primary source of income for the large majority of Forex-related companies. Many products and training programs exist solely to attract customers for their introducing broker business. Be aware of this when you see all of the products and training programs available on the internet. A clue is if you visit a site looking for Forex trading information and it says on the website, open an account, 2 pip spread, try our trading platform, any of these things, you know right away that the website is connected with a Forex broker. The Forex broker industry is an exploding business. There are many brokers and new ones popping up every day. Many of them are actually white labels or introducing brokers for another broker. You don't necessarily need a middleman in between you and another broker. In most cases, white labels and introducing brokers don't really serve much purpose. You already know the major brokers that are available to you, and then someone will say to you in person or on a forum, hey, you really need to try this broker. This is a really good broker and we have a really great trading platform. We have good pip spread or trade execution or whatever. And then you go to look at that broker and it's just a broker that you've already heard of with a different name. Since we cannot trade Forex without a broker, just make the most of your broker relationship and let them know if there's anything you require or any aspects of their services that you do not approve of. Let them know. Make use of your Forex trading broker representatives. Call them, talk to them, get them to explain things to you. When it comes to understanding how a Forex trading account works, the person you need to be talking to is your Forex broker representative. Understanding currency pairs. A currency pair is quoted with the dominant currency first, such as the euro versus the US dollar, or EUR/USD, with the current price being quoted as 1.3234. This was the price a few years ago when I originally made this course. This means that it takes $1.32 and 34/100ths of a cent of US dollars to buy 1 euro. Since 1 US dollar is worth less than 1 euro, the euro is quoted first, and the price reflects how many US dollars are needed to buy 1 euro. It's possible that a currency pair could change in dominance. The US dollar versus the Canadian dollar has fallen in value over the last 4 or 5 years. This means that the value of the US dollar has decreased relative to the Canadian dollar, and or the Canadian dollar has increased relative to the US dollar. If the US dollar versus the Canadian dollar were to fall below the value of $1 even, the pair would need to be switched to the Canadian dollar versus the US dollar. And we've come very close to that happening recently, as the price has reached a low of 0.9058, where 1 US dollar for a period of time was worth less than 1 Canadian dollar. It wasn't there long enough for the industry to actually change the pair to start calling it the Canadian versus the US dollar, but it's possible that that could happen with any of our pairs. While not long ago this pair had reached a high of 1.6196 on January the 20th of 2002, not so long ago. Most of our pairs are not close enough in value that this would be something that would be likely to happen, but that's how it works. The dominant pair, the one that is worth the most, is quoted first, and the price reflects how many of the second currency is needed to buy the first. If the euro versus the US dollar falls in value, that means that the US dollar is increasing and or the euro is decreasing. The value of the euro could theoretically be staying the same relative to the US dollar, and the US dollar could be increasing, and it would cause the euro versus the US dollar to decrease in value. When you see economic news indicating a strengthening of the US dollar, you can expect to see the euro versus the US dollar pair to fall in value. And the reason is because the euro is quoted first, and the price of 1 euro is more than 1 US dollar. So if the US dollar increases in value, that means fewer US dollars, or a smaller amount of US dollars, would be needed to buy 1 euro. So that pair would go down. What is the bid versus the ask price? Generally, Forex brokers do not charge commissions or fees on your trades. Instead, there is a difference between the bid and ask price, and the difference is called the spread, and that's what you are charged. For instance, when you enter a trade in which you buy the pair, you get a price that is slightly higher than when you sell. If you open your trading platform and you look at the quotes window or market watch window, you will see the prices changing in real time. And if you look at the last 2 digits of a certain pair and see what's the difference between those 2 numbers, that is the spread on that pair. So you can see here that at this point in time, when this screen capture was taken for the euro versus the US dollar, there was a difference of 2 pips. There was a 2 pip spread available on the euro versus the dollar, and the pound versus the US dollar has a 3 pip spread. So even though there are no commissions on your transaction, the broker is always collecting this difference in price, the spread. Does that sound fair enough? After all, the broker provides you the opportunity to access the Forex market and to trade. Doesn't it make sense that there would be no brokers if they were doing this all for free? So let's go back to the idea of our $1,000 lot size account, this super mini account with 200 to 1 leverage. In this type of account, if you traded 10 lots and the market moved 50 pips in your favor, your profit would be $50 minus the 3 pips for the spread. 3 pips would equal 3 times 10 cents, which is 30 cents, times 10 lots, which is $3. That means your actual profit is $47, and the trade costs you a total of $3. So to get a true 50 pips of profit, the market needs to move 53 pips in your favor. When you're looking at your trading platform and you're seeing an open trade and it reflects 50 pips profit on your trading platform, that's because it already has moved 53 pips and it's displaying the actual number of profit that you would have in that trade at that time. So when you enter a trade, you will start off negative 3 pips or whatever the spread is. And so once you see profit displayed in your trading platform, that's the actual profit. Opening an account. The best way for you to start learning how to trade Forex is by opening a free demo account and start trading. As with anything, the best way to learn is by doing. All the discussion and studying in the world will not have the effect of making one actual winning trade. So you can really observe the results and experience what it's like. Finding the right broker can be a daunting task, as there are so many of them, and it is hard to tell which ones are better than others, especially if you're new to the industry. How do you choose? It's kind of hard to tell, but we'll help you. It's more important that you start trading than it is to find the right broker. The truth is, they all have their advantages and disadvantages, so just pick 1 or 2 and start trading. Here are a few brokers that are not too bad. FXCM. This broker has a large percentage of the market share in the Forex industry and is therefore unlikely to go out of business. FXCM has also responded well to customer needs over the last few years and made many positive changes. AC Markets is one of the Swiss brokers that has a reputation for excellence. MIG-FX is another Swiss broker that also has the MetaTrader platform. Deutsche Bank is a leading European bank that now also